Hello friends, today I want to talk about how to invest without incurring headaches and how to make our capital grow a little bit more so that we can be independent from the need to be employed. So that's the aim. Now, just a caveat: this is not going to be a quantitative, highly sophisticated, trading or investment approach. It's going to be very qualitative. But it has worked for me, and so I want to share that with you. And before we delve into it, this requires a little bit of work. So if you're not willing to do a little bit of work but want to invest passively, so as 95% of people, then you're better off investing in an index fund. You're going to get the results of the market at a very low cost. So for 95% of people, it's best to invest in an index fund. Now, if you're willing to do a little bit of work, which is, a few hours in a week here and there, and keeping your ear to the market, then I think this approach could be interesting. So let's dive in. So first, how do I identify opportunities? So typically, I keep my ear to the market through some news outlets. I like Bloomberg. They're very factual. They don't have a lot of opinion pieces, so I can follow the news. They have also summary emails that they send for subscribers, which are very, very effective. So I can read in the morning and in the evening, most of the stuff that's happened. There's also another interesting platform called Seeking Alpha, where it's a lot of retail investors that share their opinions. They write pieces about different companies. So these can be quite good sources to just have an ear to the market and follow what's happening. Typically, I wait for a negative signal. And this is when a company is really discussed negatively in various different news outlets or social media. Typically, this is a signal that there might be here more than just the opinion of analysts. There might be here a psychological element that everyone is basically turning their back on a given company and where the share price now is reflecting something psychological rather than factual matters. For this video, I have actually two great examples that are currently happening. The first one is Boeing. If you have looked at the news recently, you saw that they had a pretty dramatic incident. There was an Alaskan flight where there was a cover installed on the plane to close a door that was not supposed to be used on the 737 MAX, the newer model of Boeing. And after takeoff, this cover was ripped apart, leaving a hole, which of course sucked the air out and was very dramatic and probably very scary for people. Thereafter, airlines have looked at those types of planes and found that there are some loose bolts in various pieces of the aircraft, and this type of aircraft has been grounded. So it's pretty negative, pretty dramatic. However, there's now a lot of negative chatter everywhere about Boeing and basically ridiculing how can this jewel of the American industrial base has fallen so low. If I look at the price now, it's fallen from $260 a share a month ago to now around $200. And to me, this is already a signal that, okay, let's have a look at potentially the fundamental aspects here. This could be interesting. There could be a psychological element at play here. So second, then I make an assessment about whether there is indeed value in this opportunity. And typically, I would first start at looking at the industry dynamics rather than at the details of the company. More often than not, the dynamics of the industry are much stronger than whatever a company can do or whatever a management team can do. Warren Buffett himself said that between an excellent management team in a shitty industry and an average management team in an excellent industry, he would take the second option. So it's reflected really in a lot of cases. In this case, so you would need to do a little bit of research about the industry. If you know nothing about the airline industry, then here a few hours researching the structure of the industry would be very, very important. So what do I know about the industry? Basically, the industry, the airline manufacturing industry is a duopoly. It's basically Boeing and Airbus. Why is it a duopoly? Well, because it takes a lot of capital to design and produce new aircraft models. It takes really in the tens of billions of dollars to manufacture those new models. And typically, both companies have received a lot of government subsidies, as well as commitments from customers to enable the funding of these models. One of the newest models that Airbus has developed in the last few decades, the A380, the really big wide-body aircraft, hasn't been profitable, but they have invested a lot of money. But what they have found out was that airlines cared more about fuel efficiency rather than the volume of passengers they can transport in any given route. Because if you have very fuel efficient aircraft that are maybe smaller than the A380, you can be more flexible. You can redeploy them on routes that have less volume, whereas the A380 basically is only able to really serve high volume routes, typically Singapore to London, these type of routes. So there is huge barriers to entry because of the capital required, but also because of political reasons. And of course, US, European airlines tend to typically buy from Airbus and Boeing. There is a matter of trust. On the smaller scale of aircrafts, there are competitors. There is Embraer from Brazil, there is Bombardier from Canada, and there is the Chinese. They're trying to enter the market. But typically, especially the Canadians and the Brazilians, they're really they've entered the really small haul flights. They haven't even been able to compete on, let's say, medium-term flights like 2 hours or 3 hours. That's still really the domain of the A320 and the 737 from Boeing. So why is it important that we have a duopoly here? Well, basically, this ensures a kind of a rational behavior in the industry and a certain level of profitability for the two participants here. Clearly, the customers of both manufacturers do not want to end up in a situation where there's only one player here, because the one player will become a monopoly and will increase prices to the highest possible level. So even though Boeing is undergoing a lot of trouble right now, we are pretty sure that there will be market forces and political forces that will drive a resolution of these issues to ensure that the market stays at least a duopoly as it is now. There are no other players that can come in and really disrupt the market. So whether it is Boeing or whether it would have been Airbus, if I see that one of those players is their share price is coming down, I think to me it's an opportunity to basically buy into the market. The profitability in the industry is going to be decided by the demand and the supply of aircraft. The supply is quite constrained. Both Boeing and Airbus have backlogs of aircraft, so they have multiple years of backlog, and it takes time to build these complicated machines, and so they work through the backlog. The demand varies based on the economic situation. So during COVID, of course, demand for air traffic collapsed, but since then it has increased and increased. There's something in the human nature. We all want to travel around. I'm shooting this video from Vietnam, whereas I'm normally based in Europe, and I'm going to travel more, and I see more and more people that want to travel. So the demand is going to be, in the long term, increasing and increasing. So the fundamentals of the industry are quite strong. So then, what else do I need to really look at? To be honest, not much more. I do not really need to go into the details of the financials or of the problems that the company is having now. This is done by analysts and is to some extent reflected in the price. So now the price is $60 off 260. So that's already 30% off. And now, do I think that the company is not going to go back to a situation where the projections of 1 month ago could be valid, let's say in a year or 2 years' time? To me, that's unlikely. I think that there will be a resolution. Clearly, there's a lot of focus now from the authorities, from customers. This is not something that's related to technology. This is not something related to the industry going in weakening. No, this is related to specific processes and ways of doing things that are internal to Boeing, and at some point they will be resolved. So then, when I have this conviction that okay, there is value here, then I take a position. So how do we size an investment? To me, I would not complicate it more than saying you should split your portfolio between 10 and 20 names. This is probably good enough. You know, there's a lot of discussion about diversification or not, and to me, 10 to 20 gives enough diversification. But the reality is that if there is a systemic crash from the market, like we had in COVID or in 2008, the reality is any portfolio will be suffering. There are sophisticated ways to hedge potentially a portfolio, but for you and me, they are not available. So we just have to be cognizant that we're going to diversify those company-specific kind of issues, but we're going to have some market risk anyways. Then how do we size the amount we can invest in a single company? To me, I look at it this way. How much can I stomach in terms of losses if I had 2 or 3 of my investments basically losing 50%? Can I sleep at night well? Am I going to check the stock price every day? This is the qualitative assessment to me that, okay, I can lose that amount and I will not be, really suffering mentally. So let's say the amount we've sized is $10,000 and we want to invest in Boeing. So I would not invest the full amount immediately. I would first take a small position of, let's say, $2,000 or $3,000 because we don't know when the share price will bottom out. If we are right and there is a mismatch between the market being a little bit emotional and our assessment, which is a bit more fundamental, well, we don't know when the market will come back to a more rational position. So we just take a small position and then see how things develop. Then my next trigger is if the share price comes down again by another 10%, then I buy another $2,000 or $3,000. This averages down the cost progressively, and then I can have some leeway, so I can weather another 10% decline. I can buy a little bit more, and then I'm pretty comfortable that okay, over time I will have made a good enough approximation to the low point. And if the share price doesn't continue and after to go down, then I will have just $2,000 or $3,000 invested and a little bit of profit on that, which is fair enough. It's impossible to time the bottom on these opportunities. Another recent example, which I just want to add as an example, is Tesla. Really, Tesla has released some numbers recently that were disappointing the market, and the share price has gone down. Again, the market reacts a lot based on recent news. So now the share price is 182. We're at the end of January, and it was basically 3 months ago. It was 260. 260 seems to be the right number for these two opportunities. So you see there is an $80 now decline. Again, when we look at the dynamics of the market, we see that the electric vehicle market has interesting dynamics. It is clearly going to be the future. Even the legacy manufacturers are moving towards electric vehicles. However, they have problems. They have an entrenched cost base of manufacturing sites, but also a skill set of workers that's dedicated to combustion engine. It's very difficult to change all of that to serve electric vehicles. It's not a matter of just saying, oh, this plant now is going to do electric vehicles. You really need different machines, a different way to assemble the vehicles, something that Tesla doesn't have since it's a pure electric vehicle manufacturers. Now, there's competition from the Chinese, BYD. There's a question mark. Okay, is Tesla going to be the Apple of the industry, which is just going to focus on premium software-driven kind of vehicles? That could be a scenario. I don't think that the Chinese will suddenly become dominant. It's an industry when it was about combustion engines that basically had many, many players. It wasn't an industry that allow itself to be like a duopoly or oligopoly of a few players. It's once manufacturers do the same thing, then it becomes about marketing. So Tesla could have its share of the cake and survive and be a profitable manufacturer. Now, what else do I know about Tesla? Well, they are currently developing Optimus, which is going to be a robot, and they want to be manufacturing a robot that can be used in both manufacturing environments, but also at home over the long term. I can guarantee you that none of the value of this opportunity is factored in the projections of analysts at the moment. Why? Because it's very difficult to know. I mean, if they achieve their aims of building a robot that's cost effective and can really replace manual labor, blue collar labor, this is going to be a huge, tremendous value, in the trillions of dollars. If they don't, of course, it will be zero. And of course, analysts, financial analysts, typically, it's very difficult for them to include that in their assessment. This would be saying, based on nothing but projections, we're gonna, include that. But what we know about Elon Musk is that when he's serious about some effort, typically he tends to deliver. And they have already shown a few demonstrations of the robot, and the pace of progress that they have shown over the last 18 months since they've become really serious about it is quite impressive. So to me, this is an occasion again to buy into a company that's potentially going to be the most valuable company in the world because of their robotics, but also AI achievements. Recently also Elon Musk has asked to have more shares in the company. He currently has, I believe, 10 to 12% of the shares, but if he wants to develop these society-changing technologies, he would like to have at least 25% of the shares. So he's basically signaling that he wants a bigger package to be able to be influential enough that he's not at the mercy of financial investors that can come in and disrupt his vision. And well, if I was the board, to be honest, I would immediately give him this package, because he's shown with the last package, incentive package that he has had, that he can deliver. And he's earned, I think, $100 billion by delivering tremendous value to Tesla shareholders. So the factors are here in for really great value creation. And I believe the market, again, while the fundamentals show that there is some weakness now, clearly there's a bit of emotional thinking around the company. Elon Musk as a figure also attracts a lot of negative headlines in a lot of industries. You immediately see on CNBC or all of these financial news outlets these activist investors coming out criticizing him as being volatile, and they are uncomfortable being with such a CEO. And to me, this is very emotional, because when you look at the track record of the guy, it's like this is quite ridiculous. So that's another name where opening a position could be interesting in the same way as Boeing. Again, tremendous potential to buy into really solid companies that have the advantage of being in industries with great dynamics. So this was a little bit off the cuff, informal explanation of how I look at investments. I hope it helps. I hope it makes you feel that it's not that complicated if you're willing to take, a calculated risk, and if you're willing to make a little bit of work, then you can achieve results that are a little bit better than the market. And of course, that helps us in our endeavors to for whatever goal we want, and to basically stay independent financially. So hope it was useful. So thanks for watching. Take care.